Hello, I'm Doug Fabian, president of Fabian Wealth Strategies. Today is November 9th, 2016, and today's presentation, Post-Election, A Path for Cash. We had a historic election last night, and we had a surprise victory by Donald Trump. The Republicans now control the White House, the Senate, and the House of Representatives. This was really an unexpected outcome, certainly from the mainstream media. But I'm not sure anyone predicted that Trump would win and the Republicans would be in control of both houses of Congress. This is an unprecedented mandate. I can assure you that change is coming. And with change, there is uncertainty. But also, opportunities are going to be presenting themselves. And that's what I want to talk about today. Now, as I get into today's presentation, let me begin with a disclaimer. Fabian Wealth Strategies is a registered investment advisor. Myself, I am a registered investment advisor representative. The information expressed in today's presentation is for information purposes only and should not be construed as a recommendation to buy, sell, or hold any specific securities. Fabian Wealth Strategies may own securities listed in this report for client accounts. And Fabian Wealth Strategies does not guarantee the accuracy of the data contained in this report. Now, I'm making this presentation primarily for clients, managed account clients of Fabian Wealth Strategies. Now, I have opened this presentation up to Inner Circle members. Inner Circle members are people who are receiving my weekly email that contains a link to my podcast. We're going to talk about the state of the markets today, opportunities for growth and income, and most importantly, as I try to do each and every week when I do my podcast, as I have for the past 15 years, I want to help investors achieve their goals. Now, this first slide, Investors on the Sidelines, is very important. And this data, according to a Bank of America study in September of this year, global investors' cash holdings are close to 15-year highs and levels not seen since 9/11. Well, my commentary on this is cash, cash, and more cash. Investors have large cash positions. Some people are all cash. And why is this? Well, I believe it's just a general lack of confidence and concern about uncertainty. But also, as you know and have listened to my podcasts, I'm a big disciple of Tony Robbins. And one of the things that Tony Robbins talks about in his live presentations that I have attended, that sometimes in life or in business, and especially in investing, you can get inside of your head. And all of a sudden you have voices in your head. And it's very confusing. If you're a consumer of the mainstream media, if you're consuming lots of publications, it can get very confusing. But too many voices can cause you indecision. And I think that that's where many people are at today. But turning back to my slide here, I want to point out that everyone's worried, or I should say many people are worried, about the next big risk event. In our business, they're called tail risks. And on the right-hand side of the slide, the number of people responding to this survey listed their number one concern is an European Union disintegration. Second concern is a crash in the bond market. Third concern is a Republican wins the White House. Guess what? We've got number three. In reality, not only the White House, but the Republicans are in control of Congress. Number four is inflation. So you might have your own reasons that you should be concerned. But one of the things that I want to do today is I want to give you a path for some of your cash. Because we know that you're not going to achieve your goals and you need cash flow and you need income. You need growth in your assets. You're not going to get that sitting in a money market fund at 0%. So you're going to need to take some risk. And I'm going to give you today some well thought out ideas, strategies that you can implement on your own. And these are strategies that I am actually implementing for my clients. So I've really thought these things through. And I've taken into account all of the issues that are in play today in the financial markets and the like. So let's continue. This next slide, financial markets on the cusp of change. I have listed just some general area of the asset markets, and let me just go through them briefly. U.S. equities. Well, U.S. equities, and I'm going to show you a chart of these things in a few minutes, but U.S. equities are about 3% above their 200-day moving average, and we've been in a correction for the past 3 months relative to U.S. equities. Developed markets, and these are markets like Europe, Japan, and Australia, they are 1% above their 200-day average, and they have corrected, gone actually even through a bear market in the last 12 months, a fall of more than 20%. And they're sitting right at their long-term moving average. The emerging markets, they're sitting about 5% above their 200-day moving average. And the emerging markets, in my opinion, are in a new bull market, which we'll talk about in greater detail. Next, interest rates, they are rising right now. Fixed income investments are actually falling in value because of rising interest rates. The U.S. dollar has been strong of late. Gold is in a new bull market, and oil is also in a new bull market. So there are risks here and there are opportunities. And one of the things that I want you to take away from today's presentation is just sitting in a passive S&P 500 income fund might give you some average rates of return, but I don't believe it's going to give you the rates of return that you desire on your portfolios. And if we are going to have higher interest rates, if we're going to see higher inflation, then you're going to need a completely different mix of assets than you had in the last several years to achieve your goals. So let's talk about today's agenda. In today's agenda, we are going to talk about 3 strategies for investors looking to be defensive and income-oriented. And when I say defensive, it means that you're going to be invested in an asset class that doesn't have serious downside risk. You're just concerned about downside risk. You want to be more defensive, and you're not trying to swing for the fences and get big returns. Defensive and income-oriented. Second, we're going to talk about 3 strategies for investors focused on growth. There are those of you in the audience and clients of mine who have tasked our team with, I have these retirement assets that I need you to get me growth on. So we're going to talk specifically about some strategies for growth. Not trying to overwhelm you with too many strategies here today, because I believe that if you get too many choices, you may not take any action. So I'm keeping the presentation relatively simple and giving you some of my best ideas, and also for my clients where I'm implementing these strategies along with others for them, I'm giving you the details as to why we're entering into some of these new positions. Let's talk about expected returns. Well, we all know what the expected return is for cash. The expected return for cash is 0. That's just it. There was a time where money market funds paid 3%. Hey, there was a time when money market funds paid 6%. But today, money markets, savings accounts, CDs pay virtually 0. Next, we have the broad category of fixed income. And there's an ETF AGG, which represents kind of like core holdings in the bond market. And AGG is yielding 2.3% right now. So in a rising interest rate environment, if you hold a bond investment, you're still going to get the interest that that bond yields. But your chances of any upside capital appreciation are virtually 0. And if interest rates go up enough, they could actually create a negative total return because the losses in bonds go past the yield that you're receiving in that income. So the math is just not good for the bond market today. And then lastly, equities. And we're talking about U.S. equities here. And from Ned Davis Research, a big research firm looking at the U.S. presidential cycle, notes that the S&P 500 posts its weakest returns in the first year of a 4-year election cycle. Since 1900, stocks have gained just 3.4% on average in a post-election year. So when we look at expectations, we could probably expect the average. So next year, the S&P 500, let's kind of say it's going to do between 3 and 5%. Not very exciting. But again, today I am presenting ideas outside of core bonds, ideas outside of U.S. equities, certainly outside of cash, that can give you returns that you could be satisfied with or even excited about. Allow us to continue. Let's take a look at some of these financial markets in pictures. And this is a great opportunity because I can't do this in my podcast. I can't give you this picture of the market when I'm talking about what has happened of late. But now, in this post-election environment, I can. And these charts are posted through Tuesday, November 8th. So here we have the S&P 500. And you can see this is a 3-year chart of the S&P 500. When you think about equities, you have 3 choices. You have U.S. stocks, you have international stocks, which I call developed markets, which are Europe, Japan, Australia. And then you have emerging markets. We're going to look at all 3 in just a moment. But I want you to know, for the past 5 years, the United States has clearly outperformed all 3 of these equity assets. The United States has been the top performer. And I'm not saying that the United States can't continue to perform in the future as well. But we have to understand where we are in a market cycle. And we have been in a bull market for 7+ years. So, the average bull market lasts 6. So we have to realize we're late in the cycle. But at this particular point in time, there is no sign of a recession. And we are sitting 3% approximately above the 200-day average, which is the blue line on this particular S&P 500 chart. You can see in the past 12 months, we've had 2 sharp corrections in the S&P. The first correction in August of last year was about 10%, and then we had a second correction in December, January, which was 12%. And then we rallied all the way to a new high in July and have subsequently corrected about another 5%, and we have bounced off the 200-day average. So those of you who have followed my work know that the 200-day average represents a potential area of a sell signal. We did not get a sell signal when we touched the 200-day average last week on the Fabian plan, but there you have it. Let's look at the developed markets. And again, we're using an ETF, EFA. This is the Morgan Stanley EFA index. EFA stands for Europe, Australia, and the Far East, and that includes Japan. It does not include China. And you can see there has been a lot more volatility in this particular chart, and we all know about the problems in Europe and also the problems in Japan. And those problems haven't gone away. So I will note that we have had from $65 a share in May of 2015 down to $51 a share. That is a 20%, more than a 20% drop. So we've had a bear market in international stocks, and we've started a new uptrend here, and we are sitting, again, about 1% above the 200-day average as of today. And then the last market I want to share with you is the emerging markets, ticker symbol EEM. Looking back on 3 years, we can see that this ETF went as high as 44, fell down to 28. That is a significant correction and bear market because the highs in emerging markets were reached in 2011. So since the highs in 2011, the emerging markets are down 45%. That's almost the equivalent of the financial crisis. That's a significant, significant bear market. And now we've begun a new uptrend. And in reality, the emerging markets are the markets that are in the strongest position because they've had the deepest bear market and they've started the new uptrend. Very nice price pattern here of higher highs and higher lows. And again, we are sitting on about a 5% differential between the current price and the 200-day average. Now, before I move on, let me give you some commentary on the election and the market action overnight. I'm sure you were all watching the election returns come in last night, and I'm sure you heard the commentary that the futures markets and some international markets were down sharply. There was a point in time when we were lock limit down in the futures, which is a 5% loss. Futures cannot move more than 5%. Certainly when the market opens the next day, they can move more than 5%. But when the markets opened post-election, we fell about 1 to 2%, and then markets have rallied. And so all of this, worry and consternation about, Donald Trump and we were going to have a severe correction was kind of put to rest in the early trading today. And as I'm doing this broadcast, the markets are trending slightly higher on the day, up 0.5% or so. So, again, this is not an indication of what might happen in the weeks ahead, but when I take a look at the emerging markets, which is the last slide we have up here, emerging markets are down 3% today. Well, Mr. Trump, President-elect Trump now, has talked about, of course, making some changes to trade deals, particularly focused on China, and there could be some increased volatility in the emerging markets in the weeks and months ahead. And that could bring the emerging markets down, 5%, 10% from where they stand right now. But again, we don't know what the final policies are going to be. And, of course, Mr. Trump does not want to see a global bear market, a global recession. He wants to see economic growth. And so I'm not as worried that the international markets are going to spin out of control here, even though there is going to be some volatility that is in play. But I do want you to keep in mind that from a value perspective and from where we are in the market trends, I think the emerging markets on a 3 to 5 year basis have the most upside of all three markets. And also, and again, we have some important elections coming up later this year and next year over in Europe. Again, depending upon how those elections go, there could be some volatility, there could be some changes. But at some point in time, we're going to get some opportunity in international markets as well. And then, of course, we'll see how new policies work out within the United States here. But I'm not calling the current bull market over. Not seeing a recession on the horizon, even though I did see today on Yahoo Finance that there are some saying that Trump's policies are going to cause a recession in the United States. Well, that is yet to be determined. But again, one of the things I'm focused on today is price, and the price trend is still positive in all of these equity markets, and I would view a correction, 5%, 10% in any of these markets as an opportunity to be able to get positions established for growth down the road. So with that overview of the equity markets, let's turn to fixed income. And there's some big changes happening in the fixed income world. This is a chart, 3-year chart, of 10-year Treasury bond yields. And the data point on the far right-hand column that shows the yield as of the 8th was 1.86. Today, the yield on the 10-year Treasury bond went to 2%, went to 2.00. You can see we had a low in yields in July of 1.36%. We have been rising ever since. We've now gone to 2%. There is definitely a trend change in the bond market. I also want to point out that the number one asset class for taking on new money this year has been bonds. So investors are continuing to exhibit herd behavior when it comes to their investments. Bonds had a great year in the first half of this year, but bonds have started to show some weakness of late. So let's realize that 10-year Treasury bond yields have broken above their 200-day average, and that is significant as we're going forward in time. This is a price chart of the TLT, the 20-year Treasury bond. There was a point in time when TLT, this bond ETF, which represents long-term bonds, was up 16% on a year-to-date basis. And it's given up a lot of those gains. It's down almost 3% today. So, again, there is change afoot in the bond market. And I believe that many investors, if they have been, kind of following the markets and getting involved with things that have been working over the last several years, you can see from this 3-year price chart, owning long-term Treasury bonds has been a great investment. But I believe that that trend is coming to an end. And it's going to be important to change your thinking. Here is that aggregate bond. This is a combination of Treasury bonds, mortgage bonds, corporate bonds. And you can also see this trend is starting to change and go towards its 200-day average, not as radical as the long-term Treasury bond in and of itself. But again, the best I think you can hope for from aggregate bond total return next year is 2%. And I don't think 2% is going to get you to your goals. So that's why I'm pounding the table that it is time to be looking differently at the investment markets. And when you see these pictures, these trends start to become rather obvious. Now, it's time for us to get into our strategies. And for my clients of Fabian Wealth, these strategies we have already begun to implement. We have not built out all of the positions in every strategy, but we've already begun to build some positions. And I'm going to talk about the strategies in more detail. The first strategy I have for a defensive income portfolio is a strategy to replace your bond holdings. If you have a PIMCO total return fund, for instance, I believe that you would be better off in inflation-protected securities. Now, these are bonds that will pay you additional returns if inflation goes up. And as we look at some of the policies, and if you listen closely to President-elect Trump's speech last night, he talked a lot about improving the infrastructure in the United States. This is roads, bridges, airports, walls, all those kinds of things. And so I believe that President Trump is going to be taking to Congress a spending package that is going to result in a lot of new infrastructure around the country. Right now, we are at almost full employment in the United States. So when something like this happens, it can be great for wages. But the downside of great for wages is higher inflation. Now, inflation has been completely off everybody's radar for 3-4 years. And matter of fact, surveys 6 months ago, inflation was the furthest thing from investors' minds. Nobody was worried about inflation, and the Fed was trying to get inflation going because it was less than 2%, and we were on the cusp of falling into a deflationary environment where wages go down, where prices of goods and services go down. Deflation is what we had in the 2008-9 financial crisis. So nobody wants deflation. So a little bit of inflation, no problem. So owning TIPS is a good investment strategy in an inflationary environment, and I think 2017 could be in an inflationary environment. So I have 5 ETFs here with varying degrees of duration. And you can see this column to the right of the name of the security entitled TRRYTD. That's total return year to date. And the Vanguard short-term TIPS fund that has an average maturity of 3 years has got a total return this year of 2.56%. We have a similar product from iShares. Now, the Flex Shares is just a 5-year TIPS product, up almost 6% so far this year. We have the iShares 7 to 10-year TIPS, up almost 7% this year. And then we have the PIMCO 15-year plus TIP, which is up 15% this year. I was noticing today, TIP securities, even though Treasury bonds are down 3%, TIP securities are down just slightly. So when you own this particular security, you're owning it for capital appreciation. You're not going to get a dividend income stream from these TIPS, but I believe that the 5-year, looking kind of at the average, has the opportunity to do between 4 and 6% next year. And for a low risk situation, I think that makes a lot of sense. So TIPS is my first strategy for defensive income investors today. And we've begun to implement this for our Fabian Wealth Strategies clients. Second, I want to talk about multi-assets. And I'm going to spend a few minutes on this because you need to get your head wrapped around this concept. A multi-asset fund is an ETF that is made up of securities from different asset classes. For example, the DWIN. This particular ETF, and if I can skip forward to the next slide, the DWIN example, this ETF owns, if you look at the right-hand column, some MLPs. It owns some REITs. It owns some preferred stock ETFs. It owns some emerging market debt. And it owns some global short-term debt. So basically, this exchange-traded fund product has 5 sleeves. And the 5 sleeves are invested in 5 different areas of the income world. And there is with this particular ETF, there is a dynamic monthly rotation strategy that steers the portfolio away from underperforming segments to more better momentum yield positions going forward. This ETF can also start to own cash or treasuries if it needed to. Now, backing up to the previous slide, the total return year to date for DWIN is 9.7%. Its yield is 5.5%. So look at the yield column on these 5 examples that I have. You can see that, obviously they average about 5%, but the total return, very nice numbers. Certainly, the total return of the S&P 500 is 5% so far this year. These ETFs are doubling what the total return has been of the S&P 500 so far this year. And what you're getting when you own a multi-asset ETF is you're getting some stocks, some bonds, some alternatives, depending upon the particular ETF that you own. Now, those of you who are not clients of Fabian Wealth Strategies, I would want you to do your homework relative to these multi-asset ETFs. Now, the last one on the list here, the Arrow Dow Jones Global Yield, this is an international-based multi-asset ETF. So it's going to have more international securities in it. But you need to do your homework so you know what you're buying. Certainly, for clients of Fabian Wealth, we've done our homework. We know what we're buying. And this is an asset class that we really like next year. And it gives a little bit more equity risk, but not extreme equity risk. And it gives you great opportunity for total return. Now, what if the stock market went down 10%? A multi-asset ETF has a beta of about 0.5, about half of what the stock market is. So if the stock market corrected 10%, this ETF would go down 5%. Now, I'll mention CVY on here because it has a little bit more equity exposure. That could be down 8%. But again, I'm not making a recommendation for a particular security. I'm expecting those of you who are implementing your own strategies and managing your own portfolios that you need to do some homework here. And you need to look back historically at these different examples and see what kind of volatility is in play here, and choose an ETF according to your risk tolerance. This is the kind of work, of course, that we do for clients of Fabian Wealth Strategies. But multi-asset ETFs are a relatively new asset class, and it makes building your portfolio much easier. Let me go to our last strategy for defense and income. And the last strategy is twofold. Emerging market dividend ETFs, those are equities, and emerging market fixed income ETFs. Now, those of you who just like, I can't take stock market volatility, I would point you towards the fixed income. But I would mention that even in an inflationary environment, even in a rising interest rate environment, the emerging market bonds have a tendency to continue to perform well. They have different characteristics than U.S. bonds. And there has been a vast period of underperformance for both emerging market dividends and emerging market fixed income. So I'm very comfortable in mentioning emerging markets here. Now, I will also mention, going back to the election, that there is going to be some short-term risk relative to emerging markets and a Donald Trump president-elect, because Donald Trump has made a strong case for changing some of the trade policies that we have with people around the world. And that is going to create some, which I believe will be shorter-term volatility. And so, we might get a steeper correction in emerging markets. So from a timing perspective, I'm not green-lighting going into emerging market dividends or emerging market fixed income tomorrow. I believe that we have to allow, and as I mentioned, when I came into the studio to record this on November 9th, emerging markets dividend ETFs were down 3% today, where the U.S. stock market was up. Why are they down so much? Because of the Trump election. And so there is going to be some uncertainty here. We're not going to completely remove uncertainty. But from a valuation perspective, emerging market dividend ETFs present excellent value. And look at the dividend yields. The dividend yields in the high fours. Wisdom Tree is, 3.65. The dividend yield of U.S. equities is less than 2%. So you're getting much better dividend yields with emerging markets, and you're getting great price appreciation as well, as you can see. As I mentioned, S&P 500 up 4 to 5% this year. The total return on these ETFs, 22, 24, 26, and even in the fixed income area, 12, 13, 14% total returns. These are very nice total return numbers. So there's going to be some volatility in emerging markets on a shorter-term basis. I would expect that volatility is going to present opportunity. It is so important, ladies and gentlemen, that you get into the habit of buying assets on weakness. You don't always want to buy something when it's going up. You want to buy something when it is turning, when it's corrected, these kinds of things. Keep that in mind. Let's turn to our growth strategies. And again, we have 3 strategies for growth. The first strategy is emerging market equities. And as I mentioned, I believe that emerging market equities are going to be under some pressure in the, let's say, weeks, maybe a couple of months. Going to be uncertain for emerging market equities until you get a little bit more clarification, until we all get more clarification from the Trump administration of exactly what countries they're going to work to renegotiate, just how much they're going to get done through Congress, these kinds of things. Obviously, a Trump administration is not going to take the reins until January 20th. So we still have time here. But certainly, I think we're going to see some trends emerge. But there's 3 areas of the emerging markets that I want you to be aware of. Number 1, we just have the broad emerging markets, which Basically, one exchange-traded fund owns 900 securities that are in 23, 24 countries all over the world. Number two, we have emerging market regional ETFs, where we have Asia or Latin America or the Middle East in my three examples here, and investing accordingly. And then lastly, we have single countries, where you can invest in India, you can invest in China, you can invest in Brazil. There are over 50 single country ETFs that are available. I'm just giving you some sampling here of what's going on. But I want you to be thinking about getting more emerging market exposure in your portfolios and looking at this on a long-term basis, because they have significantly underperformed over the last 4 years, and historically they perform as well as U.S. equities. And so once we go through a recent bear market, as I mentioned, the bear market for emerging markets just came to an end in January of this year. Certainly, if we had another global bear market, these are going to go down. But there are no signs that we're going back into a global bear market today. Needs to be monitored. Risk needs to be monitored going forward. So emerging market equities is my first strategy to introduce you to that is certainly not correlated to the S&P 500. Next, another strategy for growth is the precious metals and the precious metals miners. These are two very different areas of the marketplace. Let's begin with the precious metals, the physical ETFs. I'm giving you three choices here, the GLD, SLV for silver, and OUNZ. Two choices for gold. We are in a new bull market with precious metals, in our opinion. We have an allocation for all of our clients in the precious metals area. And we believe that the recent correction we just went through in the precious metals, something we've been waiting for to allocate more money, has passed. The precious metals have been up post-election, and again, in an area of uncertainty, in a world of negative interest rates, in a world where there is a lot of uncertainty and concern, the precious metals acts as its own currency, because you can own gold anywhere in the world. It is a liquid investment vehicle, and people buy it in times of uncertainty. People buy it in times of inflation, which we believe is going to be increasing. So we think that the precious metals is an area for consideration for growth investors. The precious metals miners, of course, when you own a mining company, it is valued based on the price of the metal it is mining and how much reserves it has. The precious metals miners, you can see on the right-hand column, I've given you what the 2015 performance was for these different ETFs. Again, we went through a 3-year bear market in gold. Gold has been underperforming for a number of years and just turned into a new bull market this year. And we're seeing that the miners have had a very big run so far this year. But if we have a bull market going on in gold, if gold is going to go from the current price today, which is just below $1,300 to $1,500, which would be a 20% plus move, which would be nice for GLD, the miners would go up 50 to 75% on that kind of move. So you get more leverage. There's a lot more volatility in the miners. So they're a riskier investment. But this is a growth idea for your consideration. And also, of course, if we have inflation, usually gold goes up in an inflationary environment. And then lastly, select U.S. equity sectors. And there's 3 equity sectors I wanted to talk about today. Again, it is my opinion that the S&P 500 next year may just flounder. Maybe it's 3%, maybe it's 5%, maybe it's 7%. But you're going to have a lot of risk with that as well. But choosing some areas that would be specifically tailored to a Trump administration, I think makes some sense. And there's 3 areas that we like here. They are biotech, aerospace and defense, and the industrials. The industrials, of course, tie to infrastructure and a build-out of roads and bridges. The defense and aerospace is about defense spending, which Donald Trump has promised to do. And biotech have been beaten down because of a lot of worries that Hillary Clinton was going to become the president, and she was very negative on biotech and biotech pricing and regulations and these kinds of things. So biotech has been a very, very strong market sector throughout this bull market. It was positive, of course, in 2015. It struggled this year, but this clarity relative to who the leadership is going to be going forward has been lifted, and we think that some of these individual sectors make some sense. Now, before I get to my closing statements here, let me again refer to what's going on in the financial markets. We have had a historic election. There is a lot of uncertainty. And I think that maybe many people were surprised that the market did not fall out of bed today as it looked like it was going to do last night. And, you know, we've got some relative stability in the financial markets. But there is going to be change, and with that change, there's going to be uncertainty. So there is going to be volatility between now and the end of the year, maybe even into the first quarter of next year. And so I believe that your portfolio composition has got to be different. We know that yields are rising, and I'm not going to say that yields are going to go from 2% to 3%, 3% to 4%, 4% to 5%. That's not what's going to happen here. Markets ebb and flow. But we've seen the low in yields, and you cannot expect total return from the bond portion of your portfolio anymore. And the total return portion I'm talking about is capital appreciation from bonds. Sure, you can get your yield, but many people have poured money into the bond market like there's no tomorrow. So I believe that your portfolio has to have a much different makeup going forward than you've had in the past of maybe owning a core bond fund in the S&P 500 and a little bit of international. I believe that your portfolio construct needs to be much different in order to be able to get rates of return that you're going to be satisfied with. So here are the strategies that Fabian Wealth is going to be implementing for its clients next year. We're certainly going to continue to be reducing direct passive bond market exposure. We're looking for yields from sources outside of traditional fixed income. Gave you some of those ideas with the multi-asset, but we like the MLPs, we like the REITs, we like different areas of the fixed income world. And point number 3, we're increasing our exposure to equities, selecting sectors and the emerging markets, not just buying U.S. dividend stocks or not just buying the S&P 500. Obviously, we're going to continue to manage risk, and we're going to continue to adhere to our strict capital preservation philosophy. So these are the strategies that we're going to be implementing, and these strategies that I presented today in this Path for Cash presentation are aligned with these strategies that I've laid out. Now, you're a do-it-yourself investor. You're not a client of Fabian Wealth Strategies. Here's some questions to ask yourself. Number 1, what is my desired rate of return? What truly is the rate of return you would be satisfied with on your total portfolio? Is that 3%? Is that 5%? Is that 7%? Is that 10%? What is that number? What is your desired rate of return? And when I press people for an answer, I usually get very reasonable numbers from people. Nobody's telling me that their desired rate of return is 10, 15, 20%. People are like, oh, 5%. Boy, 5% would be nice. 5% would be great. 6%. Oh, gosh, if I could get 6%, But you need to know that number. If you don't know that number, how can you start to build a portfolio that has the potential of achieving that number? That's question number 1. Question number 2, does my asset allocation put me in a position to obtain my desired rate of return? And if you've got a 15% cash position, sure, the other 85% could achieve your rate of return. But if you've got a 50% cash position or an 80% cash position or you're 100% in cash, certainly you're not going to be able to achieve your desired rate of return with that kind of asset allocation. Number 3, how are my current assets aligned with future trends? And here are the 3 future trends that I want you to take away. I believe that we could see a resurgence in economic growth in the United States and the world next year. That's going to come most likely with some inflation and some higher bond yields. So do you have a large percentage of your portfolio in bonds? And if you do, you're not aligned with the future trends. And then the last question, how are my emotions influencing my investing decisions? And I talked about this at the very top of the presentation. If you're finding yourself frozen, deer in the headlights, can't make a decision, too many voices in your head, having trouble buying and selling securities, afraid to sell something, afraid to buy something, then you really need to get some help. So let's talk about next steps. Next step number 1, let's do your homework. As I mentioned with the multi-asset ETFs, very important for you to dig into those multi-asset. And there's other multi-assets. There's about 15 multi-asset ETFs now. I gave you 5 today that I like. But you've got to do your homework on which one suits you. Now, if you're in a large cash position, you need to start to add some risk. Adding risk means you're putting a position in your portfolio that has the opportunity to do better than cash. And you need to do that prudently. Now, again, I didn't want to overwhelm you with 10 strategies to build out your entire portfolio today. And if you have been a do-it-yourself investor, maybe you've got some strategies that are working within your portfolio. You've got some individual stocks, you've got a mutual fund, you've got something that is working for you. Great. What I presented today were 3 strategies for income and 3 strategies for growth that might enhance some of the things that you're already doing. So I'm expecting that you're going to put some of these ideas to use in a prudent way. That might be in the tips idea, that you're going to build out a portfolio allocation of 10% to tips, for example. And maybe you're going to do that in 3 purchases or 2 purchases. That's prudent and calculated. Next, you got to review your goals and objectives. We're going into the end of the year. And we've got a new president, a new Congress. There's going to be new opportunities. There's always opportunities in the financial markets. But you got to know where you're at and what you're doing. And then lastly, I'll mention our new personal wealth coaching service that we offer through Fabian Wealth Strategies. This is a fee-only service where we do a deep dive on your portfolio, have a discussion about your goals and objectives, do a write-up that includes a portfolio of exchange-traded funds. I give you a 30-day and a 90-day action plan. It's a great way to quick start you on your wealth-building endeavors if you're finding yourself not moving forward. So those of you who are clients of Fabian Wealth Strategies, and I want to thank you for your trust and the opportunity to serve you through our wealth management programs. And, of course, I hope this presentation should help you understand some of the things that we're going to be purchasing in your own accounts. For those of you who are Inner Circle members, you know how much I enjoy getting behind this microphone in my studio here each and every week and having a conversation with you about your wealth-building endeavors and what's going on in the world. Certainly, there's a lot going on in the world today, and I think that there's going to be a lot of opportunity in the future. There's going to be bumps along the way, but I believe that there's more opportunity than there is risk, and so I want to help you achieve that. So if you have any comments or questions, please give us a call at 800-391-1118. You can send me an email, info@fabianwealth.com. And I look forward to speaking with you each and every week on my podcast that you can reach through FabianWealth.com. This is Doug Fabian. Thanks for joining me today.